the history of Tesla dying. There has been several episodes where Tesla stock was declared not really dead, but pretty much was selling off. The shorts were all over it. There has been times even before the Tesla went public when the company supposedly was dead, according to Elon Musk. So this episode is a little bit of a reminder of how many of those epochs we went through as shareholders of Tesla. And in light of where we are today, which is unfortunately another one of those moments where Tesla stock looks like just in a free fall. There's no buyers, there's just sellers, and the price keeps declining every day by 2, 3, 5, today 6%. I think on the one hand, it's good to go back in history and understand, okay, what does this mean? Is this different? Or maybe this is something special. But also, I think it's important to understand that maybe in order to understand what's going on today, it's worth thinking back and analyze the situations when the company or the stock or both were in trouble. The purpose of this podcast is to give people a sense for what it feels like to run a hedge fund. Tesla is our largest position, and we're suffering a lot because of that, because the Tesla stock is underperforming pretty much everything at this point. And that's, of course, painful from a P&L perspective. It's painful from a investor client perspective. And you have to manage that as a hedge fund manager. This is a good lesson for everybody out there of how to deal with these types of situations. This episode hopefully can help you guys not just weather your P&L if you're in a similar situation like us, but also I hope gives people a bit of a sense for what it takes to go through these types of situations. Think back, analyze, and try to remember how it was back, how it felt back then when you were in a similar position. This is not even on podcast. It's November 21st, 2022. This is Krim Telco. For the day, the fund is down roughly 3%. The market's down 30 basis points. For the year, we are down 60.2%. The market's down 15.1%. We're underperforming by 45.1%. So let's focus on the episodes that we remember as shareholders of Tesla when the stock was selling off. Let's define first what selling off means. What the selling off means is systematically underperforming the market, moving on almost no news. Basically, when there's more sellers than buyers, and it's not an earnings call or something like that, it's a persistent movement in the stock, repricing the stock, changing ownership of the stock. Because here's what it really means when the stock consistently sells off. There's a shift from one set of owners to the other, and it usually takes some time, and that's why the stock keeps selling off. Because when you have a shift from owners, it's obviously not the case that you might also find a new class of buyers at the same time. So there has to be a repricing of the stock. The same, by the way, happens on the other side. When the stock rallies, then there's a new set of buyers stepping in and buying the stock at a higher price. So what we have now is a consistent selling pressure, and that's what we mean with selling off. Some of the indications that the stock is selling off, most importantly, it's when a stock is underperforming the rest of the market and its peers, which is happening right now. And then also when there's typically quite a lot of volume, which we have right now, and we also don't have specific news that we can say because of this the stock went down. So all of these things are happening. Now, on the news front, of course there are news. I mean, Twitter is a big news item right now that is driving at least the sentiment around Tesla, because the CEO of Twitter is the owner of Twitter, which is Elon Musk, who is also the largest shareholder of Tesla and the CEO of Tesla. And because Twitter is very politicized, there is a lot of back and forth and a lot of noise. Our thesis is that actually Twitter is not that instrumental in the Tesla stock. Why? Because it's not shocking to the market that Musk bought Twitter. We knew that for almost a year now. So that's not really the absolutely new news. Now, there's certain things that are happening, maybe the mishandling of some things and the risk actually that somebody might hurt Musk, I think, is higher. It's not shocking to me. Again, I expected this to happen. But still, when it happens, it kind of sinks in and you're kind of scared. Hopefully, every day you might hear news that somebody tried to kill Musk or something like that. And you don't want that, of course, to happen to anybody, but particularly not to the CEO of the company that you have a lot of your money invested in. So now let's talk about two episodes in the past. And we at Orange Capital Partners have been in Tesla since around for about 10 years. So we've seen a lot of things happen, and there's been lots of periods when the stock was flat and doing nothing. I don't want to talk about those. What I want to talk about is the specific periods when the stock was selling off. So the most prominent one was the one when Model 3 was supposed to be launched, and then it got delayed, and there were problems with Model 3. The risk with that was twofold. One, we weren't sure if they actually will figure out how to produce that car. And second, they were building this whole infrastructure, the Gigafactory in Nevada, the Fremont factory, everything was being built out for this massive volume car. And then, of course, if you don't have the volumes, you're sitting on a massive amount of fixed cost, and you don't know if you can ever produce the car. Forget about demand, forget about people being skeptical about the car because it's being delayed. All of these things, of course, added to the confusion. But there could have been a problem along the lines of, well, we underestimated the technical difficulties. We need another year or two to figure out what's going on. Something like that could have happened. So the market was very, very scared. And it doesn't matter the details here, but I think, let's say the stock was around 360 or 380, and it went down to about 150, 160. So it sold off by roughly 60%. So this is kind of the territory where we are right now. Stock's down about 60% from its highs. So we're in similar territory. What happened back then was a serious problem that put the company on the line. What's happening today is a serious problem in two following ways. One, Musk is being irritated by Twitter. He's not focused. There is definitely going to be slack. There's definitely going to be some mistakes happening with Tesla and issues and all that kind of stuff, just because he's, as a CEO, is not fully there. So that's definitely a risk worth something to be, there has to be a marginal seller in the market that is going to sell the stock just because they don't want to be exposed to this. The other risk is China. China is a big risk because it's irrational and absurd. Today, the news was that somewhere people died, I think it's Beijing, I'm not even sure, 3 people died between the ages of 85 and 92 of COVID, and they're locking down half of China or something like that. It's absurd. I personally don't believe that COVID is the driver of all these crazy movements in China. There's other alternatives. I do believe that they are doing these lockdowns. I'm hearing it anecdotally also from people who actually live here in Los Altos and just came from China and stuff like that. The point is the following. I think that the Chinese government is cracking down on the freedom movement in China. It's cracking down on the desire to have more voice, and it's using COVID as a pretext to tighten. Now, this is, of course, very bad for China and very bad for the Chinese people. Just as a tangent, it should also hopefully help us understand here what it means when we let bureaucrats start telling us what health policy means and let them do lockdowns and mask wearing mandates and all that kind of stuff. But that's just a tangent. Let's get back to the topic here. So we have these two big drivers, which is Twitter, distraction for Musk, and China. So these two drivers together have sold off the stock. And now the math here is the following. The stock is down 60% from its highs. But of course, not all of that is driven by this, because there's also macro and the market's down 15% for the year and all that kind of stuff. So therefore, how much is it really down? Our guess here, Orange Capital Partners, we're probably down around 25 to 30% based on these things. Now, this is good and bad news. The good news is, well, we're not selling off that much, but the bad news is, well, because of that, we have more downside. And what are we looking at? We're looking at okay, before I go into the valuation and the logical question that comes from all this is, okay, where's the bottom? When will this sell-off from this side of the market hopefully turn back to the buyers? Or when will the overwhelming selling pressure yield to more buying pressure? And this usually happens when there's fundamental buyers, when there's a fundamental desire to buy the stock, and that's usually an evaluation. So we'll talk about that. But before I go there, I just want to mention one more episode when the stock was again under sell pressure, and that was when Musk got in trouble with the SEC following his failed attempt to take the company private. Back then, it wasn't as bad. I think we had maybe something along the lines of a 20% sell-off from pre to after this happened. So let's say that the bid was obviously 420. I think the stock was around 380. So, and it went maybe down to 250. So we went from 380 to 250. That's like 30-40%, something like that. So again, now let's compare this to today. I think we really have a relative sell-off of more than 25-30%. So we have a little bit more to go. And I think now let's talk about this valuation stuff. So what is valuation? Valuation is when you look at the company's fundamentals, when you look at the sales, the margins, and the earnings, and then you compare it to the price that you're paying for the company, and then you compare it to the rest of the market, and you try to evaluate, okay, is this an investment that's worth making based on the expected return, or is it not? Tesla is supposed to print something around $80 billion in sales this year. We believe that the company can do something in the maybe 12% net margin range. Let's say they can do something like $10 billion in net revenue, in net earnings, 3.2 billion shares. So we're looking at something like 330, 340 per share. 330, 340 per share at 160. We're looking at sort of mid-40s PE for this year. We expect around 40%, 45%, about 50% earnings growth, We expect about 40 to 45% of sales growth in the next couple of years, compound, meaning every year. And then we expect the earnings to grow a little bit faster because we have operating leverage. By the way, the reason the net margins are so high is because the company is not paying taxes right now. So there's a tax provision to be made. So the actual net margin is lower than reported. But I think the market is just looking at cash on cash, and the company, because of net loss carry forwards, has not been paying tax. It has no tax liabilities yet. So anyway, that's just to sort of put that aside. But the point is now the following. I think that given the fundamentals, which by the way are very strong, that's a very strong margin for a company like Tesla, which is still an industrial company making cars. To have double-digit net margins is amazing. And therefore, we also have a high valuation. Now, a company like Tesla should, in normal times, be trading more like 8 to 10 times sales. Why? Because it's growing fast, it has lots of software, it's disrupting the market. So if you add all these vectors together, people are willing to pay very high multiples on sales, particularly since there is actually a real profit and real free cash flow underlying the company. So you're not looking at some SaaS company which is subsidizing sales. We spoke about this last week when we sold Twist and analyzed companies that grow without profit. This is a company that grows with profit, which is incredibly valuable. But in this environment right now, we're just not going to get this 8 to 10 times sales. So what are we getting instead? We're looking more like right now something like 7.5 times current sales, and more like 5-6 times next year's sales. So it's less. And again, that's fine. The purpose of this exercise is really to say, okay, are we cheap enough? In other words, is this worth investing right now, knowing that all the selling pressure is coming? Is this worth investing? And the answer is no. it's still not cheap enough. If I'm a value investor, if I'm somebody that doesn't want to invest in fluff, in technology, in futuristic, visions, FSD, software-defined cars, whatever the buzzword is, if I don't want to invest in that right now, and I just want to look at financials, I have to say, look, I'm still paying quite a lot for this thing. I'm not going to buy. I'm going to wait. It's too risky for me. And if I miss it, I miss it. So that's unfortunately the way it is. In other words, we still have downside here. What's the downside? Well, the good news is it's not that much. Because if you're looking at, let's say, let's be aggressive, 50 times earnings. If we go down to 30 times earnings, so we're looking at something like $100 a share. Now, when I say not much, it's still, of course, it's a lot. That's 30% downside from here, but 40%. But for Tesla and its volatility, historic volatility, I mean, but we're not talking about a stock that can go to 2 or completely like down 90% or something. There is fundamental value. We believe that somewhere in the $100 range, probably more like 110, we will find actually fundamental support. Now, what does this mean for us? Do we sell the stock now and wait till it gets to 110 and buy? Well, no, it's not that easy, because we could be wrong about this and miss out. And then what do we do if the stock goes from 170 to 220? Do we then buy? It's very tricky. Also, we have tax liabilities to deal with as investors. So we want to be very, very careful with trading around this stuff. We've said many times before, the goal of this fund is to hold as long as we can, or hold on to Tesla stock. So what we're doing, we're managing our leverage. We make sure we have a decent amount of leverage, which is below 25% of NAV. We're not going to go above 25% of NAV. And whenever we reach that level, we sell. That's what we do. It's not the best policy. It's a costly policy. It's being what volatility traders call short gamma. But this is the way we manage the fund. And maybe in another multiverse, we would be differently positioned. There's a couple of reasons why we manage the fund this way and not another way. Some people, they put cash aside to have dry powder when they can, when to buy and things like that. We just don't do it that way. And that could be wrong. It's not, we're not saying there's only one way. That's how we decided to do it. And we're paying a high price for this. There's this conversation of stacking and Bitcoin mining in the Bitcoin space. We're kind of neither of those. The stacking is kind of like, okay, you just sit on cash and you keep buying when it's low, and you kind of, low cost average and things like that. I have to say, I'm not a big fan of that either. These strategies, they always come up when it's like short sellers. They show up on Bloomberg TV when the market's down. When the market's up, you're not, the most money, here's the thing, the most money you make in investing is when good companies do a lot of good things and generate a lot of good wealth. That's when the most dollars are made. The dollars are not made by trading around, shorting stocks, timing, getting in and out of stocks, long, short. None of that stuff makes money. The actual dollar for dollar, cash on cash, best investments are those when you buy a good company, and with good, I mean, let's go back. Disney, when it started, and then went public in the 40s, 50s, Hewlett-Packard in the 40s, 50s, Coca-Cola in the 50s, 60s, Microsoft in the 80s, Apple in the 90s, Amazon in the 2000s, Tesla in the 2010s. Those are the big companies, the big money makers, because they do something good. They solve hard problems. They reduce entropy in a field where entropy hasn't been reduced before. And they're able to do that in big markets where there's lots of people benefiting from them. What does big market mean? That means lots of people see the benefit and they channel their funds into that type of product. That's what a big market is. That's when you make the most money. So we're trying to be those types of investors. Our annual CAGR still now, even after this dismal performance, is still in the mid double digits. Maybe we haven't done the actual numbers yet for the last quarter, of course, because we're still in the quarter. But as of the third quarter, we were somewhere like in the 14% range. We've lost some money since then, so we're probably more like in the 12 to 13% annual CAGR since inception in 2008. So we have nothing to be ashamed about. Nevertheless, our investors, of course, are unhappy this year because we lost a lot of money this year. What I'm trying to say is that we believe, as hard as it is right now, that our strategy still is the best strategy, which is stay long, invest, borrow a little bit of money, and then keep that money invested in high return assets. Our cost of capital is Tesla, because that company is the best returning company in the coming years. Why? Because this goes back to our natural Sharpe ratio, or for people who aren't familiar with it, simply a company that can iterate in a way that the costs of errors are small, the error correction can be done at low cost and fast. They can iterate around very difficult problems, solve those problems, and create products and services for a lot of people around the world to benefit from many, many advantages that those products and services give. Convenience, lower cost, fun, and for those who care also, forget environment, but it gives you more flexibility in how you fuel your transport and your house. Flexibility, we're not talking about decarbonization or things like climate change, none of that stuff, but it gives you more flexibility at a cost competitive price. That's a good thing. So all of these things together, that's why Tesla is the best investment we still foresee for the foreseeable future. Right now it's suffering because of the factors we mentioned. We also went back and discussed why that is not new and that has happened before. And this is part of when we say volatility is part of the business. It's not just a nuisance. It's because when you have this iteration, when you try new things, then you sometimes come into potholes. You hit potholes, air pockets, where it's tough. And then you figure it out and you come back. And I think Tesla is in that kind of situation. And therefore, we're still very optimistic about the expected returns of Tesla, which even now, with all the recalibrations of margins, etc., we still believe that we can make a 25% ROI on this investment in the coming years. Thank you.